In this week's video, we'll review the latest technical and fundamental data to help us answer the question, will Trump's tariff tweets push the economy and stock market off a bearish cliff? In the first 5 months of 2019, we've covered numerous data sets that have told us to be open to better than expected outcomes from a long-term perspective. Here's another example from a third party of something measurable that's already happened in 2019. Twitter handle here where my cursor is. In this case, after this happened historically, the average gain in all of these cases looking out 1 year was 13.55%, and maybe more importantly, 96% of the cases historically were positive 1 year later. Screenshot from the April 19th video. Short-term becoming more vulnerable to a normal and to be expected 4 to 10% pullback. And this bullet point here, for the most part, was based on bird strike data. And prior to the onset of the current pullback, and or during the early stages, our mix of stocks, bonds, and cash already reflected this realistic probability. One of the logical ways to look at it is to ask this question. When the market is up here, is our mix of stocks, bonds, and cash in line with the present day evidence, taking into consideration that something in the order of a 6 to 10% correction could be coming our way? And recent videos and tweets, including this May 20th tweet, was our way of saying it's time to get mentally prepared for a 100% normal and to be expected pullback. On April 19th, based on the data that we have in hand, including the bird strike data, the basic take is during a 4 to 10% pullback, we're comfortable with our present allocation, and during that pullback, we'd like to make as few changes as possible. So, based on the April 19th video, April 26th video, screenshot, May 3rd video, screenshot, we're getting ourselves mentally prepared for the fact that this type of trend is not going to continue indefinitely. If we fast forward to the close on May 31st, 2019, thus far, the correction or pullback is at 6.58%, which basically aligns with this message that we were delivering in here prior to the onset of the decline. The average between 4 and 10% is 7%, and we are definitely still in the normal and 100% to be expected neighborhood at this point. So in the remainder of the video, we'll basically be asking, given what we've seen in the past 4 weeks, does it negate these bullish probabilities? And we have to keep in mind, when we're up here, this bullet point makes a lot of sense. It's a little bit different if we fast forward to the present day, because it's very, very easy to say, yes, we've only pulled back 6.58%, but what about the trade war, and what about the president's tweets? Well, in recent years, when we pulled back 6.58%, we could have said, what about the flash crash? What about European banks? They're going to go under. What about the U.S.? It's about to default on its debt. What about negative interest rates? Yes, we're only down 6%, but what about Brexit? The data still looks different. What about the U.S. election? As noted on short takes, at this point here, we have to keep in mind that every 4 to 10% pullback in the history of the stock market was associated with some type of fundamental and or technical concerns. Thus, the concerns in the present day are not really unique in any way. And at face value, it would be logical to say that Trump's tweets change everything in the stock market, and the charts cannot account for Trump. And there is some truth to that. Markets always have to adjust, but when you get right down to it, Twitter is just a new medium or delivery system. It's not really that much different if the president or calling press conferences. The only difference is you can make an argument that the tweets level the playing field. Everybody gets the information at the exact same time. If they schedule a press conference, there's going to be leaks, and some people are going to find out in advance. Just as we can say, what about Twitter? It's a game changer in the present day. In the past, in the markets, we could have said, what about Morse code? It's a game changer. What about radio? It's a game changer. What about the telephone? It's a game changer. TV is a game changer. Televised press conferences are a game changer. The internet changes everything. It will never be the same. Everything in that list is basically a new delivery system. Yes, things are different, but one constant is the markets are always adapting to new technologies and new delivery systems and mediums. And market participants take everything into consideration, including the President of the United States and how he runs his administration. It's very, very difficult to look at this chart here and say that the charts are not reflecting uncertainty related to the president's delivery system, management style, and the uncertainty related to the trade war. In terms of what we cover in these videos each week, Trump and his tweets are reflected 100% in the data and the charts that we show. And both of them and the uncertainty related to them will continue to be reflected going forward. Let's update the April 5th analysis because something material has changed on this chart. As of the close on May 31st, 2019, we now have a bearish cross on the S&P 500's weekly chart, a cross that is occurring above the center line. This is the data from April 5th. You might remember in the 16 historical cases with the similar setup, 100% of them were higher 2 years from the date of the signal, or in this case, the signal that was covered in the April 5th video. A video that was based on the 5th weekly close, MACD close, above the weekly center line. 7 weeks later, we updated the study after the 12th consecutive weekly close. The data looking forward from that point historically painted a very, very similar and positive picture looking out 2 years. Thus, given the bearish MACD cross that occurred this week, it's logical to ask, what happened in each one of these instances after the first bearish cross following the similar setup that we've been covering in recent weeks? So we want to walk forward from the similar points in history. So we went back in each of these cases, found the 12th weekly close above the center line, weekly S&P 500 MACD, and then walked forward until we found the first bearish cross similar to what just occurred on May 31st, 2019. Does a bearish cross significantly change the outcome walking forward from this point? The answer is no. No significant change. 1 month, 50-50 coin flip. 2 months, 75% of the cases positive. 3 months, 75% positive with an average gain of 3%. 6 months, median gain of 7% with 81% of the historical cases positive. 1 year out. Thus, in the historical cases, if you walk forward 1 year from this look, 93% of the cases were positive with an average gain of almost 15% and a median gain of 14%, and very, very similar to week 5 and week 12. 2 years out, 100% of the cases historically saw the S&P 500 rise by an average of 27%. The median gain was 23%, which is not significantly different from these numbers at week 12 and these numbers at week 5. Simply telling us this isn't necessarily a showstopper walking forward. It's very, very difficult to say this is a positive development. There's no question this is deterioration in the data and something that we have to respect walking forward in the present day. If you want more detail on the original MACD setup, you can find this video here, dated April 5th. May 31st, 2019, daily chart of the S&P 500, the 100-day simple moving average in blue, the 200-day in red. The setup, bearish cross, stays below the 200-day for at least 90 calendar days, and then we get a bullish cross. So this is our signal here. How many times has this happened in the past, and can we learn anything from it? Thus, we'll find the historical cases and walk forward basically from this point here historically. Similar setup has gone into the history books 26 times in the S&P 500 in the last 70 years. Here are the historical dates that are similar to May 22nd, which was the date when the 100-day finally closed back above the simple 200-day. What happened next in the stock market in the historical cases? The results not that much different from the MACD study. 2 years out, 92% of the cases were higher. The average gain was 22.5%. The median basically the same, which speaks to consistency in the outcomes. Everything that we've covered, including this table here, simply helps us assess the probability of good things happening in the future relative to the probability of bad things happening. And as the red portions of this table show, the probability of bad things happening is never zero, telling us to keep an open mind about worse than expected outcomes in the present day as well. The historical probabilities are unquestionably favorable. We're going to quickly cover some highlights from a very, very popular Fed Watch blog. You can find it by Googling this title here. I think it's interesting to note, you will see someone coming at the problem from a totally different perspective is drawing similar conclusions. The job market feels like a repeat of the patterns of the data around 2015 and 2016. Cases that we've covered recently, and we will cover and update this period in this video from a technical perspective as well. Still from the Fed Watch blog, 2015-2016 economic weakness was concentrated in the manufacturing sector. We're seeing something of a repeat now, although less disconcerting at this point, meaning the present day looks better than the data in 2015-2016. In the blog, they go on, clearly the current weakness in the data does not compare to 2015-2016, let alone a recessionary type decline. FedWatch blog on recent housing data. This historical pattern suggests that we should take comfort in the housing numbers. The data also matches the 1994 to 1995 pattern, a period that we have covered numerous times from a technical perspective and fundamental perspective, and a period that we will touch on again in this video. The blog also notes that the bar to raise interest rates is relatively high relative to the current data and the Fed's MO historically. Hitting just the highlights, there's a lot more detail on the blog. Bond markets continue to signal that the Fed's next move is a rate cut. Market expectations of a rate cut are well founded. The yield curve suggests that the path of activity will require a rate cut sooner rather than later. But the yield curve is a long leading indicator. It's typically well ahead of the data, a topic that we have covered numerous times in these weekly videos. This is a very, very important nugget here from somebody that follows the Fed very closely. The Fed's typical pattern ahead of a rate cut is to resist, and then move quickly. We mentioned earlier in the video that the S&P 500 closed below the 200-day moving average on Friday, May 31st. As we've covered in the past, brings up a logical question. How concerned should we be when an index, stock, or ETF drops below its 200-day moving average? Here's a tweet from Friday's session from a third party. Historically, that's been a really ominous sign, meaning dropping below the 200-day moving average. Unquestionably, there's some truth to this statement here. However, history tells us, and we can illustrate with an anecdotal example that covers several years. The S&P 500 from this point A to this point B gained roughly 77%. In this case, were drops below the 200-day moving average helpful between point A and point B? More specifically, how many times did the S&P 500 drop below its 200-day moving average between point A and point B? The answer is a neck snapping and whipsaw inducing 81 times. And remember, on Friday, May 31st, 2019, we closed below the 200-day. Thus, it might be helpful to know how many trading days between point A and point B, which featured a 77% gain in the S&P 500, how many trading days ended with a close below the 200-day moving average? The answer is 186 trading days. Moral of the story, like any technical, signal, or measurable event, context and the weight of the evidence matter. We also want to make it abundantly clear. We're not trying to say this is irrelevant. It's very, very relevant. It just has to be taken as one piece of evidence. Thus, getting back to the main theme in the video, all of the bullish data sets that we've covered in recent weeks and months, have they been negated by the current 6.58% pullback? On February 19th, 2019, we covered a rare Bollinger Bands setup on the monthly chart of the S&P 500 that went into the history books on January 31st, 2019. It's relatively rare for the monthly chart to start above the center line, drop below the center line, get a monthly close below the center line, never touch the lower Bollinger Band, and then get a monthly close above the center line. This is somewhat of a head fake look. The market is very, very concerned. The Fed flip-flops. The market's not concerned anymore. Using an oversimplified fundamental example. If you go back and look at this post, a similar setup occurred 13 previous times going back to 1950. And once again, high percentage of positive cases looking out 2 years with very, very satisfying returns. If we fast forward to the present day, as of the close on Friday, May 31st, 2019, we just printed the 5th consecutive monthly close above the center line. Thus, it's logical to ask, from the signal that went into the history books in January of this year, and the 13 similar historical cases going back to 1950, how many of these 13 cases were able to print 5 consecutive monthly closes above the center line? And in those cases, what happened next in the S&P 500 if we walked forward? The answer is, out of the 13 cases, 4 of them didn't make it. 9 of the 13 were able to print the 5th consecutive close above the center line. Very, very similar results if we walk forward from the dates in history that are similar to this point here, or May 31st, 2019. Out of the 9 historical cases, 100% of them green a year later in the S&P 500, average gain of 11%. 2 years later, 89% of the 9 cases positive with an average gain of 24% and a median gain of 29%. And the updated results that we've covered thus far in this week's video are a good proxy for the weight of the evidence that we have in hand as of the close on Friday, March 31st, 2019. We really shouldn't be shocked after a move like this to see a pullback like this. In fact, given our current allocation, which already includes some cash and bonds to account for the possibility of a move like this, or even a move all the way out to roughly 10%, during Friday's session, we had a cash file ready based on the facts in hand at this point, which are obviously subject to change. Our preference would be to redeploy cash if we come down in this area and show some signs of holding over reducing exposure to risk. Thus far, we really haven't seen anything shocking. 6.58% pullback falls into the somewhat normal and to be expected category based on historical cases from this post here. The givebacks from this point here in the historical cases range from 4.29% to 9.94%. If we were to exceed this number for any length of time, that would be concerning. And we absolutely positively may do that. We haven't done it yet. And our current allocation, most importantly, is not based on the historical studies. It's based on these numbers. These are the numbers in the present day as of the close on Friday, May 31st, 2019. Trend strength, short-term score, 84.86, and the more important longer-term trend score, 98.9. We haven't had to make a lot of changes thus far because the bird strike work already had us in a somewhat of a how would we want to handle this type of pullback posture. Now, obviously, we can't cover everything in these weekly videos, so we try to pull out some things that highlight the weight of the evidence. Two of the cases that are similar to the present day. The bottoming process in 2011, there's a breadth thrust here. 2014 to 2016, we get a similar breadth thrust here. In both cases, we get failed breakouts and a relatively painful correction when you're experiencing it in real time. On a closing basis, in this case, it was 5.6%. This is June 1st, 2012. This is June 27th, 2016. This is bonds versus stocks, so we're looking at defensive versus growth. TLT versus SPY in the ETF world. This is a weekly chart as of May 31st, 2019. Where does June 1st, 2012 and where does June 27th, 2016 fall on this chart? The answer is in this region here, which acted as resistance for this ratio, and in this region here, which acted as resistance for this ratio. We're in a very, very similar spot in the present day. We also have very, very similar momentum profiles in each case. Again, this is something that we can see and measure in the present day. This is what's important. This is simply a reference point to understand what this may or may not mean. Obviously, if this ratio breaks out in a convincing manner and fails to look like this going forward and really doesn't look like this going forward, then that's also useful information. That absolutely positively may happen, and it may happen next week, but it hasn't happened yet. In the stock market, what happened next from this point here and this point here? After the 9.94% correction and a failed breakout, after the 5.6% correction, which came after a failed breakout attempt here, in both cases, good things happen for a long period of time, simply telling us to keep an open mind about the possibility of the market righting itself sometime in the coming days or weeks. Anything else particularly noteworthy in the present day that might align with this period here? Twitter handle here. May 30th, 2019. Yields on 30-year treasuries have fallen to the lowest level since 2016. Yields today, very, very similar level to this period here, which is June to December 2016. Where is this period on the S&P 500's chart? Yields today similar to June to December 2016. This is June to December 2016. This is what happened next in the stock market. Is it possible that it's different this time? Absolutely, positively, yes. This is simply a reference point, helping us understand this data here in the context of the S&P 500, chart patterns, breadth thrusts, and corrections following a breadth thrust. So 2016, you can make an argument we have a similar chart pattern. 2016, you can make an argument we have a similar setup on the TLT-SPY weekly chart, a similar momentum setup. You can make an argument that yields, which is somewhat reflective of this chart here, it's just another way of looking at the same issue for the most part, yields are in a similar area to this area in here. It's a lot of similarities telling us to keep an open mind in the present day. None of this dictates how we manage our assets. It's the hard data that dictates how we manage our assets going forward. Are we allocated properly based on everything we know, based on these readings and the model's output? Remember, the trend strength score is one input in the master market model. The answer is yes. Is there anything else that tells us to keep an open mind about the present day being similar, potentially, to the bottoming process in 2016? Or even 2012, which is also covered in that blog post? The answer is yes. Covered this in January of this year, somewhere around the neighborhood of January 8th, if memory serves correctly. The S&P 500 came down and kissed an upward sloping, in this case, 200-week moving average, and then rallied to a new high. 2016, this is the point that we've been comparing in previous slides, June of 2016. You can make an argument that this look here is similar to this scare, and here we go again, look here. And this look here is similar to this look here. This point here is similar to this point here. We get a breadth thrust and a 100% normal and to be expected give back here after holding, in this case, at a downward sloping 200-week moving average. Anything else that we can learn from this look here? In the context of an ongoing bull market, the S&P 500 held at an upward sloping 200-week moving average, near it in 1987, 1990, and above it in 1994. Also noteworthy, the present day, which if we look in the rearview mirror, we came down and kissed an upward sloping 200-day, rallied hard to a new high. This really doesn't look much like this case here. Dot-com bust bear market. We come down to the 200-week moving average, slice right through it, and instead of going on and rallying to a new high, we barely make it back above the 200-week and then fail. Compare and contrast this look right here and this failure to this strong rally here to a new high. Compare and contrast this look here to this look here, where we do bounce at the 200-week. It's a pretty shallow bounce, and then we fail miserably. Very, very similar to this case here. On this bounce, we never even remotely come back and challenge these highs, never even get in the neighborhood of the previous highs. All of this simply speaks to probabilities. None of it can predict the future, and that's why the present day data governs our actions. Back to Tim's FedWatch blog. Tim is performing fundamental analysis for the most part, yet his take on the yield curve is similar to our take on the yield curve. Why is that? We're both making decisions based on what's actually happened in the past and forming a hypothesis based on what's happened in the past. As we've mentioned in past videos, the 10-2 is an important part of the yield curve. It has not inverted yet. It made a low in December, a higher low in March, a higher low relative to the two previous lows in May, and this higher low came after a breakout and a higher high. Nothing's really changed relative to our view on the yield curve. You can find it by Googling this title and watching this March 29th, 2019 video. And you may remember, rate hikes followed by rate cuts doesn't mean the stock market is doomed. Yield curve inversion followed by rate cuts doesn't mean the stock market is necessarily doomed. Another third party. Bond market inversion resembles 1998 MarketWatch article, marketwatch.com, at MarketWatch on Twitter, dated May 29th, 2019. Let's look at some shorter-term tactical guideposts on the S&P 500. This is a DeMark chart. DeMark charts and indicators are proprietary tools from Market Studies, LLC. These are the two gaps, the primary gaps that we've been watching over the past few weeks. This gap here is the gap mentioned in this May 20th tweet. We're very, very close to the gap here, but we have not hit it yet. It's very, very possible, as noted on Twitter. This is possible support. It's really just a reference point. It's not a binary line in the sand. This gap could eventually hold, and we could drop below it and stay below it, close below it. DeMark gives us a propulsion reference point below it at 27.19. This could act as an area of possible support or a bearish guidepost. Also noteworthy, the propulsion upside magnet, previously here for DeMark, has now moved here to 3054. Does that mean the S&P 500 is going to 3054? Absolutely, positively no. Just speaks to probabilities, telling us to keep an open mind about a rally above these highs here. We also have a gap, a downward gap here. So there's really two gaps here. The original gap was here on the way up. We also gapped down below it on the way down. We have not totally filled this gap. So it's also possible, even if really bad things happen, that we would come up and revisit this level here. That's 2851. That's roughly 100 points higher than where we're closing on May 31st, 2019. There is also another gap here, a very small gap that has already been retested. We came back, went into this gap, but we did not fill it. So it is possible that we will come all the way back and actually fill this gap. A gap fill goes all the way to the bottom of a gap. A retest goes in the gap and rallies before hitting the lower level. Thus, it's possible that this gap is still in play. Simply a reference point, a reference point, a reference point, and another potentially unfilled gap here that could work as a magnet in a bullish manner. The market will make all of those decisions. All of it falls into the to be determined category. And for us, based on where the data is, if we don't hold, let's say it's a week from today, so at the end of next week, we're precipitously below these levels here. The odds are extremely high that the data is going to make us execute an incremental defensive move. This is kind of the gray area here for price levels and the data. How is it going to turn out? We have absolutely positively no idea. We'll take it day by day with an open mind. Another third-party source, May 30th, about the trade war. Quick note here on the bullets left in the Fed's gun. If we assume the federal funds rate is at 2.5%, hypothetically, the Fed could cut rates 10 times in a quarter-point increments before reaching zero. Interest rate cuts, interest rate hikes have psychological impacts on the markets. Experience tells us unequivocally that 2 to 5 to 10 rate cuts would be very, very relevant in terms of the markets and the Fed's effectiveness. Thus far, we haven't even hit the 32.8% retracement relative to this low. These are some additional guideposts here that can help us with probabilities. Down here, this is the percent of S&P 500 stocks above their 200-day moving average. These green lines here represent past levels of support after a similar breadth thrust up to this blue line. This shows us how far back this indicator came in those three instances. These are three historical cases in green that are similar to this breadth thrust here. Moral of the story, we're in the area here that so far matches these three historical cases. If we move into this area here and stay there, we will learn something about bearish probabilities. This also falls into the category of we really haven't seen anything yet that looks all that abnormal relative to expectations. To summarize, right now, given what we know today, we're in the middle of a 100% normal and to be expected 4 to 10% correction. Our allocations align with the present day data, which will govern our actions going forward. If the data continues to deteriorate, at some point we're going to make some incremental adjustments. That statement is based on our current allocation and the current data. Thus far, we've not seen anything particularly surprising or out of line with the previous data, meaning the data that we've seen in the rearview mirror and the historical cases. However, the margin of error is shrinking here. If we see much more deterioration, we're going to start to drift from expectations. We also have to respect that some major shifts have occurred regarding China and Mexico, and the market is adjusting to those shifts. Going forward, we have to respect all outcomes, including seeing the present day chart morph into a devastating and long-lasting bear market. The further the data drifts from the current data-driven script, which means the data that we have in hand, the further we drift from that data-driven script, the more concerning it becomes from a risk perspective, and we will make adjustments. However, we must also respect the current data-driven script, and odds are still in place, and they tell us to be open to, not forecasting, not expecting, open to a reversal in the S&P 500 in the coming days and weeks, and eventually new highs in the S&P 500. How can you say that? Stocks went significantly higher in these two similar cases. Stocks went significantly higher in these 9 historical cases that are similar to something that has already happened in the present day. This has nothing to do with forecasting. This is present day data looking at historical data and then walking forward. How could we possibly be open to new highs in the S&P 500? This just happened. We can see it, measure it, and put it in a model. In the 26 historical cases dating back to 1950, in roughly 90% of the cases, historically, the stock market was higher looking out 6 months to 5 years. simply telling us to keep an open mind about new highs in the S&P 500. If something like this happens, we're going to make several new all-time highs. We also have to keep an open mind about worse than expected outcomes. If you're watching these videos, we have to respect, what does a 92% probability mean? It's not a 100% probability. It's telling you that it's possible that the present day takes the lower probability path and produces red boxes going forward. Human beings have a tendency to think that a 92% probability is the same as a 100% probability. We all know that that is not the case. How could we possibly think the S&P 500 could go on to make new highs? This just happened in the stock market. When this happened, after this happened, in these 16 historical cases, the S&P 500 was higher in every case 2 years down the road. The key points going forward, as always, we will take it day by day. There's no forecasting here, simply assessing probabilities. Maximum flexibility allows us to push our ego aside and focus on the present day data and make adjustments, bearish adjustments if we need to, and bullish adjustments. And it's very, very possible that the data morphs into a devastating and long-lasting bear market. Possible is different from probable. Right now, this is the more probable scenario. We'll reassess those odds day by day. Twitter can also help us with sentiment. We cut and pasted this from a tweet that we saw during the session on May 31st. This also is telling us to keep an open mind about the possibility of not only a reversal, but the possibility of a relatively violent reversal and the possibility of a relatively violent reversal. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.